All right, today we're diving into a really massive shift happening on Wall Street. A top US regulator has basically given the green light to using crypto as collateral in the super high stakes world of derivatives. This is a big one. Just think about this for a second. It's Saturday night, maybe Sunday morning, the markets are going wild, and you need to post more collateral for a huge trade. What if, instead of waiting for the banks to open on Monday, you could just use your Bitcoin to do it right then and there? Well, that's not a what if anymore. It's the whole idea behind a new pilot program that could totally reshape how these markets work. But before we can really dig into the solution, we've got to understand the problem it's trying to fix. And it's a pretty fundamental one, often called the weekend problem. So what you're seeing here is this incredible mismatch. On one side, you have these massive derivatives markets that are more and more trading around the clock, 24/7. But the plumbing of the financial system, the way you actually move money with wire transfers, checks, all that stuff, it's stuck in the past. It's a 9 to 5, Monday to Friday world. So posting collateral over the weekend, pretty much impossible. And that creates all sorts of delays and risks. But digital assets, they live on the internet. They operate 24/7, 365, and they settle in an instant. So how do you solve a 21st century problem like this? Well, let's take a look at the regulator who's stepping up to the plate, the CFTC. The main character in this story is the CFTC, the Commodity Futures Trading Commission. These are the folks in the US government who oversee the gigantic derivatives markets. We're talking futures, swaps, the whole shebang. They're the ones writing the new rulebook. And the companies that are right on the front lines of this change are called FCMs, or Futures Commission Merchants. The easiest way to think of them is as the specialized brokers for the derivatives world. They handle the trades, they manage the accounts, and, this is the key part, they hold the collateral for all their customers. They're the ones who have to make this new program work in the real world. And this whole thing didn't just happen overnight. You can see here there was this steady regulatory buildup all through 2025. It really kicked off with the Genius Act, which set up a framework for stablecoins. Then a big report came out from the president's working group that basically said, hey, we need guidance on this digital collateral thing. That lit a fire under the CFTC, which launched what they called a crypto sprint, all culminating in the launch of this pilot program on December 8th. And this is what it all led to, the Digital Assets Pilot Program. This is a huge deal. It's the first official, formal pathway from the CFTC for using digital assets as margin in the US markets. It's a massive step in bringing these assets into the traditional financial system. Okay, so we've met the players, we know what the program is called. Now, let's get into the nitty-gritty. How does this thing actually work? First things first, what can you actually use? Well, for now, during this initial phase, the list is pretty short and very specific. They're only allowing assets that regulators see as readily marketable. So we're talking about the big ones, Bitcoin, Ether, and certain stablecoins that are already widely used for payments, like USDC. Now, because these assets can be pretty volatile, their prices swing up and down, right? The program has a super important risk management tool built right in. It's called a haircut. It's basically a safety buffer. So let's say a trader posts $100 worth of Bitcoin. The firm might only count it as, say, $80 of collateral. That difference, that $20, is the haircut, and it's there to protect the system if the price of Bitcoin suddenly drops. And believe me, this is not the Wild West. It's far from a free-for-all. Any FCM that wants in on this has to jump through some serious hoops. They have to officially notify the CFTC, they have to apply those risk-based haircuts we just talked about, they need to send in weekly reports on all their digital asset holdings, and they even have to get written legal opinions to prove they have a solid claim on that collateral. The key takeaway here is that this is a very, very controlled experiment. Okay, so that's the how. We've got the rules, we've got the assets. But the bigger question is, why should you care? What's the real-world impact of all this? The number one, hands down, biggest benefit is speed. We are talking about a quantum leap from a settlement process that can take days to something the source documents call atomic settlement, which is basically just a fancy way of saying it happens instantly. No more waiting for a wire transfer to clear. The collateral is there immediately. And that speed translates directly into a huge advantage for traders. The analysis from the source material says it all. The customer will be able to start trading immediately. Think about that. No more waiting for the bank to open on Monday. This is real-time, instant access to the market. Beyond just speed, the potential scale here is just staggering. According to the source documents, these new rules could unlock billions of dollars worth of eligible digital collateral. This is a mountain of capital that, until now, was basically locked up inside the crypto ecosystem. Now it can be put to work in the massive US derivatives markets.
But as with any major innovation in finance, this brave new world comes with a whole new set of risks. And there's some really important fine print that everyone is still trying to figure out.
A huge concern is that when you move collateral onto a blockchain, you're also creating new ways for things to go wrong. The sources are pretty clear that this tokenization process opens the door to new cybersecurity risks. You're creating more opportunities for hacks, for exploits, for bad actors to cause trouble. The digital infrastructure itself becomes a potential point of failure. And on top of that, there are some massive unanswered legal and technical questions. For example, how does a firm actually prove in a court of law that it has control over assets that are secured by private keys? What happens if there's a bug in the smart contract code that makes the asset go haywire? And maybe the biggest question of all, if a company goes bankrupt, how will the courts treat this new kind of digital collateral? We just don't have a lot of legal precedent to go on here.
So, when you put it all on the table, the huge potential benefits on one side and these new, serious risks on the other, what does it all mean? Let's zoom out and think about what this signals for the future of finance.
One of the most interesting side effects is the pressure this puts on other regulators. The source material makes it really clear that the CFTC's bold move is forcing the SEC's hand, putting renewed pressure on them to come up with their own clear rules. The analysis even points out that the SEC has already made some defensive harmonizing moves, which tells you that this is forcing the entire regulatory world to get on the same page about digital assets. So what this really all boils down to is that the line between the old school financial system and the new world of crypto is getting blurrier by the day. This pilot program isn't just about collateral. It's a fundamental piece of new plumbing that connects these two worlds. And that leaves us with the really exciting question. Now that this bridge exists, what gets built next?